Hey everyone, so you've probably been hearing loads of headlines about a recession. Today we're going to discuss what a recession is, what causes a recession, how to spot a recession, and finally how to protect your money in the event of a recession so you can make cash money. First, before we begin, please don't forget to smash the like button, drop a comment and subscribe. It's the only way I can keep making more content. So firstly, what is a recession? Simply put, a recession is a shrinking of the economy for 2 straight quarters. That's 6 months. It's measured by a decrease in gross domestic product. That's GDP for short. Now, GDP is effectively what we're producing and buying as a nation and is a measure of economic activity. Other major characteristics of a recession include higher unemployment and lower retail sales. The latest release for the first quarter of 2022 shows GDP fell by 1.4%. We'll find out in another 3 months just after June 2022 if the GDP has fallen again. And if it has, we'll technically be in a recession. Right now, there's a lot of disagreement on if a recession will even happen anytime soon. Recessions are very difficult to predict and very few economists have correctly predicted these in the past. And to be honest, it doesn't look like anything's different now. Many economists are forecasting a recession in the next 6 to 12 months, so anytime from December 2022 to June 2023. Most researchers are pointing to high inflation as a warning sign that a recession may be near, with supply chain issues and a hot labour market being the main drivers. The Federal Reserve raising interest rates may be the event that triggers a recession. Many of the countries such as the UK and India have started increasing their interest rates to decrease inflation. An economic downturn in the US is more likely if other larger countries are also going through the same thing. However, some economists disagree and they're forecasting consumer demand to fall over the next few months. This might even lower inflation, thereby reducing the risk of a recession. Data from JP Morgan shows that people in the lowest 20% have more money in their bank accounts than before the COVID-19 pandemic began. Also, wage growth has been fastest in low-paying jobs, rising faster than inflation, so perhaps the impacts of inflation may not be as bad as we thought. Profit margins normally decline prior to a recession, which causes companies to lower investment and job layoffs. Despite increased labour costs, corporate profits are at all-time highs. If they do start to drop, this may be a warning sign of a recession. So, what causes a recession? A recession is usually caused by a number of factors. Some of these include inflation, high interest rates, falling consumer confidence, falling bank lending, and a decline in investment. If we look at inflation, which is one of the biggest factors, things are getting more expensive, from filling up your gas tank to eating out. Inflation is the highest it's been in nearly 40 years. Inflation is currently at 8.3%, while the Fed has a target of 2%. That's quite a big difference. Research has shown that nearly all previous recessions, from the 1960s to 2008, have been preceded by high inflation rates. The way this happens is, as things get more expensive, people have less money to spend, which leads to lower economic growth. Not only that, but as transport costs go up, companies may cut back investment, again, lowering economic growth. Inflation is currently at 8.3%. So to control and lower inflation, the Federal Reserve is raising interest rates by 0.5%. The impact of this will be felt in 12 to 18 months. If interest rates are too high, this will reduce demand as borrowing becomes more expensive, which lowers spending and investment. And this will lower economic output, which could cause a recession. However, if interest rates are too low, demand may continue to increase, further pushing up inflation, and again, this would also cause a recession. Given the impact of a rate rise takes 12 to 18 months to be seen, it's a possibility that the Fed might be too scared to increase rates further, and ease off on the gas pedal, which some economists say could cause a double-dip recession. So you can see how tricky it is to balance interest rates, inflation, and timing. To make matters worse, historically, recessions have come after policies to reduce inflation have been put in place, such as increasing interest rates. The ideal outcome, and what everyone wants, is what's known as a soft landing, where inflation dips slightly and economic growth continues, although at a lower rate. Now, historically, the Fed has been poor at predicting recessions and managing economic expansion. The board of the Federal Reserve have admitted they don't fully understand what causes a recession. The impact of a rate increase is quite slow, so around about 12 to 18 months, so the Fed doesn't have many chances to get this right. And it seems the market doesn't have faith in the Fed either. A survey earlier this week found that more than half of economists and investment professionals expect the Fed to fail in its mission to engineer a soft landing, which isn't exactly what you want to hear. Another factor that can cause a recession, the global supply chain. The global pandemic has and still is causing reduced manufacturing in China. China has a zero COVID policy which causes many factories to shut down temporarily, so we can't get a steady supply of goods, further pushing up inflation. The Russian invasion of Ukraine has resulted in commodity prices increasing. Oil, gas, wheat and corn have all shot up in price. Russia and Ukraine together provide 30% of the world's wheat, and Russia is the world's largest exporter of fertilizer as well as oil and gas. Since the war, wheat was up 46% year on year, corn is up 35%. The longer the Russian invasion of Ukraine lasts, the more we could see these commodity prices increasing, putting pressure on inflation. Well, what does all of this mean for share prices? Surprisingly, as we'll discuss later on, share prices normally drop before a recession begins. So it looks like an expectation of a recession is what causes a drop in share price, rather than a recession itself. Well, how do you spot a recession? There are specific indicators we can look at to spot if a recession is on its way. Unemployment. This is a lagging indicator, so it shows up after a recession has happened. When COVID-19 hit in February 2020, unemployment reduced to 3.5%. This was the lowest level in the United States since May 1969. For now, the numbers look quite promising. Unemployment spiked to 14% in April 2020 before rapidly improving to just 3.6% in April 2022. Unemployment would spike if profit margins started shrinking and companies reduce investment, which we'll look at later on. Consumer confidence is another indicator economists look at when judging a recession. This is a measure of what consumers think about current and future economic outlook, and increased by 10% in April to 65.7 points. But it's still down 25% compared to the previous year. April 21, it was 88.3, and it's not too far from 2008 recession levels, which could be a warning sign. Also, there's still a large amount of economic uncertainty dependent on the war in Russia and new COVID strains. What's kept consumer confidence from plunging even further is a strong labour market. Workers have leverage over companies for the first time in decades, resulting in more people switching jobs and earning higher pay. One of the biggest indicators, and one most economists have an eye on, is the inverted Treasury yield curve. The graph shows yields on short-term and long-term bonds. The spread, or the difference between the yield of the bonds, is what analysts look at. When short-term bonds have higher yields, that's returns, than long-term bonds, there's a higher risk of a recession. This is because bond prices reflect investors' expectations that long-term yields will decline, which is what happens in a recession. So while an inverted yield curve is often preceded recessions in recent decades, it's not what causes a recession. Rather, this reflects investors' expectations of the future. The Treasury yield curve is currently inverted, and long-term yields are lower than short-term ones, which may suggest a recession is on the horizon. So what happens to stocks during a recession? If we study the previous 11 recessions going back to 1953, we can see an interesting pattern emerges. Stocks actually perform worse prior to a recession than the recession itself. 12 months prior, stocks are down 3%. During the recession, stocks are down 1%. And 12 months after the recession, stocks are up 16%. On average, recessions last around 10 months. The S&P 500 improved at least 8% in over 90% of the cases. So again, perhaps it's the prediction of a recession rather than a recession that actually causes the biggest drop in stock prices. So here's what you've been waiting for. What can you do to protect yourself? Well, if you're a long-term investor, which I hope you are, it's always best to stay in the market and wait it out. The markets make the biggest gains after massive losses. Just look at the stock market gain after 1 year of each of these events. If you sell your stocks now, you may miss out on future gains ahead. Remember the old adage, it's not about timing the market, it's about time in the market. One thing you should definitely do is review your risk tolerance. The question you have to ask yourself is, how comfortable are you losing a large chunk of your investment? Some investors can handle a 10, 20, 30% drop, even if it means gaining this back later. If you can't handle huge losses in your stocks, there are the following steps you can take. Diversification. Reduce your company's specific risk by spreading your investment across a number of stocks. That way, no one share price drop can have a big impact on your portfolio. If you can't choose and don't know how, it might be worth opting for an index fund, which tracks a specific index, such as S&P 500. This index contains 500 of the largest companies in the US. Another option would be to increase exposure to value stocks instead of growth stocks. Growth stocks are ones that are forecasted to have high growth rates and pay low or no dividends because they are reinvested by the company. These shares decrease the most during a recession. Growth stocks include companies such as Amazon, Netflix, Tesla. Instead, you should consider value stocks. These are companies that have low growth but pay high dividends. These stocks outperform growth stocks during a recession. Examples of value stocks include Procter & Gamble and Johnson & Johnson. Another way to protect against a recession is to have international exposure. The Fed's decision to increase interest rates has unsettled the markets. Exposure to central banks which don't have similar policies may keep your portfolio more stable. Also, it might be worthwhile increasing your exposure to bonds. While inflation has resulted in the worst quarterly return in high-quality bonds in 40 years, don't count them out. Should a recession result from the Fed's aggressive interest rate hikes, bonds are likely to do well. Recessions tend to be far kinder to high-quality bonds than they are to stocks. Both municipal bond yields and US investment-grade credit yields are at their highest levels since early 2019. In a real recession, we'd expect both of these to offer around 5 to 7% returns as interest rates fall. If you have a large amount of money to invest, it would be wise not to invest it all at once. Spread out and invest regularly, such as at the end of every month or quarter. This should reduce the risk of one large share price fall wiping out your investment. With so many signs and indicators pointing towards a recession in the near future, it's hard to deny that a recession is a real possibility. Soaring inflation, the Fed's historic track record of dealing with it, and the inverted yield curve shouldn't be ignored. Let's assume that we are about to have a recession. If the past is anything to go by, it'll most likely only last for a year, and the economy normally improves 1 to 2 years after a recession. Recessions are a common part of the stock market, and not as scary as all the headlines will have you believe. If you're in the stock market, now's the time to review your risk tolerance and see if you're not comfortable with the level of risk. I suggest taking some of the steps revealed earlier if you're not. If you are, get prepared for some of your holdings to drop before hopefully recovering. It'll be a bumpy ride. If you've enjoyed the video, please don't forget to smash the like button and drop a comment and subscribe. It's the only way I can keep making new content. For now, take care and goodbye.